When you think about the fundamental act of buying something, there's this certain rhythm to it that we're all just entirely used to.
Right, yeah, a very established pattern.
Exactly. Like you walk into a store, you bring an item to the counter, hand over your card, and you walk out. Or, I mean, if you're shopping online, you click a button, your card is charged, and a box shows up a few days later. It's a very simple one-to-one relationship between the buyer and the seller.
Yeah, it's basically the most basic transaction in commerce, right? A linear exchange of value that honestly hasn't fundamentally changed in thousands of years. Just, the medium of exchange has evolved.
But the moment you start looking at modern e-commerce,
Mm.
and specifically the explosive growth of the buy now, pay later space,
Mm.
that simple linear exchange just totally
Oh,
vanishes.
completely. It's gone.
Suddenly, checking out is no longer this private handshake between you and your customer. You are like inviting an invisible third party to stand right there between you.
Right.
You're dealing with real-time risk models, hidden merchant fees, complex legal terms that, let's be real, most people just scroll blindly past.
Yeah, the digital checkout page has just fundamentally evolved. It's really not just a cash register anymore. It functions almost like a micro-lending desk.
Right. Which brings us to our mission for today's deep dive, because if you are operating a Shopify store right now, or even just, researching the ecosystem, you're definitely feeling the pressure to offer these flexible payment options simply because consumers demand it.
They absolutely do. It's almost expected at this point.
So welcome to the deep dive. Today we are dissecting a massive 22-minute comprehensive guide dedicated entirely to adding buy now, pay later to a Shopify storefront. Because look, you're a busy learner, you value your time, and you probably don't want to read a textbook just to figure out how to run your business.
Nobody has time for that.
Right, so we are going to extract the absolute most critical insights from this source material. Specifically, we're comparing Shopify's native Shop Pay Installments against third-party giants like Klarna, Afterpay, and Affirm.
Yeah, we're going to really look under the hood here. We're talking the real fees, surprisingly strict eligibility rules that can honestly completely derail a launch, and the hidden risks that are rarely mentioned in those shiny marketing brochures.
Exactly. The goal is to give you the clarity to make a highly informed decision about your own digital checkout. And to set the stage properly, let's be crystal clear about what we're actually analyzing here. The source material is not talking about B2B financing.
Yeah, not at all.
Right. So we are not discussing you as a business owner taking out a loan to buy a new warehouse of inventory or letting a wholesale client split a giant invoice.
Yeah, we are looking strictly at point-of-sale consumer financing. This is the shopper, the person buying like a jacket or a coffee table from your website, choosing to finance their purchase through a third-party lender at the exact moment of checkout.
Okay, let's unpack this, because to really understand this landscape, we have to look at the massive fork in the road, the source outlines for merchants. You basically have two completely different architectural paths to offer this service.
Right, the native route versus the third-party route.
Exactly. You can go the native route, which means using Shop Pay Installments, or you can integrate a standalone provider. Let's start with native, because on paper, it sounds incredibly frictionless. I mean, it's built natively into the Shopify platform.
Yeah, you don't have to go hunting down a new app in the marketplace. You just activate it. Well, assuming you already use Shopify Payments and Shop Pay, of course.
Right. But the detail in the guide that really caught my attention is the underlying architecture. Because Shop Pay Installments isn't Shopify lending the money out of their own treasury.
No, definitely not.
It is entirely powered by Affirm.
Yeah, and that partnership is arguably the most important feature of the entire native setup. Shopify is an e-commerce platform, right? They build software. They do not want the regulatory headache or the massive capital requirements of being a consumer bank.
Makes total sense.
So Affirm is the entity operating behind the curtain there. They're the ones doing all the heavy lifting, assessing the shopper's credit profile in like milliseconds, and critically carrying all of the credit risk.
Which requires a completely different mindset for a store owner. It's, imagine you're hosting a lavish dinner party, right? You invite 50 people over, and before anyone even sits down, a very wealthy friend, let's call him Affirm, quietly walks into your kitchen.
I like this.
He pays you upfront, in full, in cash, for every single meal you're about to serve. Then Affirm goes out into the dining room and collects the cash from your guests over the next 6 weeks on his own schedule. You aren't acting as a loan shark, you aren't acting as a debt collector, you just cook the food and serve the guests.
That analogy perfectly illustrates the payout mechanics detailed in the guide. When a customer checks out using Shop Pay Installments, You capture the order just like a normal credit card sale. You are paid the full order value in 1 to 3 business days.
Just seamlessly integrated into your normal payout schedule.
Exactly. Your cash flow is largely uninterrupted.
But wait, what happens if that dinner guest decides they just don't want to pay Affirm back? Like, what if they make the first payment, get the expensive product, and then just disappear or completely default?
That is a firm's problem entirely. The merchant is completely insulated from consumer default risk. The lender took on the risk of underwriting the consumer, meaning they ran the math to determine if the shopper was trustworthy, and if their math was wrong, well, the lender eats the loss.
Wow. And the merchant just keeps the money.
The merchant keeps the money.
That structural setup sounds incredibly appealing for a store owner. But the source notes some very specific guardrails here. Like, you cannot offer this on a $3 pack of guitar picks, right?
No. The cart limits for the native option apply only to orders from $35 up to $30,000 in the US and Canada, or £50 to £30,000 in the UK.
Okay, so why $35?
Setting a floor of $35 prevents the system from just being clogged with meaningless microtransactions. I mean, breaking a $10 purchase into 4 payments of $2.50 doesn't provide any real utility to the consumer. Plus, the fixed costs of processing the data query make it highly unprofitable for the lender.
Yeah, that makes sense. But raising the ceiling all the way to $30,000, that fundamentally alters the business model for merchants selling high-ticket items.
Oh, absolutely. An electric bike, a custom sofa, or like commercial espresso machines suddenly become accessible to a buyer who maybe doesn't have $5,000 in liquid cash today, but they can easily manage a few $100s a month.
Which leads us to the most critical question. If the merchant gets the cash up front, takes none of the default risk, and the customer gets the expensive espresso machine immediately, who is actually funding this operation?
Right.
Somebody has to pay for the magic trick, and that means we need to follow the money and examine the fee structures.
This is a zone where merchants frequently misinterpret the documentation. Let's look at the native Shop Pay Installments fee first. Many store owners assume they are going to pay their standard credit card processing fee, say 2.9% plus 30 cents, and then pay an additional separate buy now, pay later fee just stacked right on top of it.
Oh, right. But the source guide actually goes out of its way to correct that assumption. It is a single, unified transaction fee. It completely replaces your standard credit card rate for that specific purchase.
Exactly. However, that single replacement fee is significantly higher than a standard swipe fee because it has to subsidize the entire pay over time infrastructure.
Right, that makes sense.
And that dynamic becomes even more complex when you shift over to the third-party providers. So, Klarna, Afterpay, or Affirm used as standalone apps. What's fascinating here is the deliberate opacity of the pricing.
Opacity, like they don't publish the rates.
Right. None of these major third-party players publish a simple, universal merchant rate on their public websites. You will never find a page that just says, we charge every store 4%.
Wow. So it all comes down to a private negotiated contract then?
Yep. The guide notes the fee is usually structured as a percentage of the sale plus a fixed flat fee per order, but those actual numbers remain completely hidden until you actually start the onboarding process.
Because that private rate is highly variable, right?
Yeah.
The lender calculates it dynamically based on your annual processing volume, the specific category of goods you sell, your geographic region.
All of that. But the most important variable is the type of financing plan you want to offer your customers. The lender will take a much larger cut of your profit margin if they are providing your customer with a 0% APR plan.
And APR, just to clarify for anyone unfamiliar, is the annual percentage rate, the interest the customer pays on the loan. So if the customer is paying 0 interest, the lender has to make their money somewhere else to cover the cost of capital and the risk of default.
Exactly.
So they make it by charging the merchant a higher premium. You are essentially paying out of your own pocket to subsidize your customer's quote-unquote free loan.
Which is a totally valid customer acquisition strategy, provided you actually know your margins. The danger the source highlights is that because these numbers aren't public, merchants sometimes try to build their business plans based on unverified forum posts from a merchant in a completely different industry.
Oh, that sounds like a recipe for disaster.
It is. You have to treat the specific rate you are quoted in your private contract as the absolute truth for your survival math.
Especially since the plans the customers see at checkout can vary wildly. Like, they might select the classic pay in 4 option, which is usually biweekly and interest-free. Or they might choose a pay in 2,
Hmm.
Or if they're buying that $5,000 espresso machine we talked about, they might opt for a monthly plan stretching out to 24 months.
Yeah, and depending on their location, that monthly plan can carry an APR anywhere from 0% all the way up to 36%.
36%.
Yeah. The lenders are constantly reevaluating risk on a transaction-by-transaction basis. But there is a massive operational detail buried in the source material regarding these fees that we really need to dissect. It involves how these lenders handle refunds.
Yes, this was the single most alarming part of the entire guide for me. Wait a minute. If I sell a $2,000 couch and the customer returns it, I just eat that massive processing fee. That changes the entire math on my return policy.
I know, it sounds brutal, but that is the reality of the refund trap. When you issue a refund on a BNPL order, the refunded amount is simply deducted from your next available payout. But the transaction fee is gone. It is not returned to you.
I genuinely don't understand how lenders justify that.
No.
If the sale is reversed, why does the lender get to walk away with hundreds of dollars of my margin?
Well, you have to look at it from the perspective of the financial service provided. The lender isn't charging you a fee just to move money from point A to point B.
Okay.
They are charging you for the risk assessment. They had to pull credit bureau data, run complex underwriting algorithms, lock up their own capital to pay you up front, and establish the repayment schedule. From the lender's point of view, they successfully executed the complex financial service you hired them to do.
So because they did the work, they keep the fee.
Exactly. The fact that the consumer didn't like the color of the couch is a retail problem, not a lending problem. The service was rendered, so the fee is spent. Oh, and if the customer had already made a few payments and accrued interest on a monthly plan, the lender does not refund that interest to the consumer either.
Wow. That fundamentally changes the math for a store.
Yeah.
Think about a high-volume clothing brand. In the fashion industry, seeing a 30% return rate is completely normal because people buy 3 sizes to see what fits and return the rest.
Very true.
If a third of your sales are generating a high, non-refundable transaction fee, you are actively bleeding cash on items you didn't even sell.
It forces a merchant to really recategorize returns. They are no longer just lost revenue or a slight inconvenience. They become an active, damaging expense line on your profit and loss statement. Every single return costs you the processing fee of a sale that ultimately failed.
So understanding those financial stakes is crucial. But let's assume a merchant has run the numbers, they've factored in the non-refundable fees, and they want to move forward anyway. The guide makes it clear that you might not even be allowed to use these tools based entirely on geography or your product catalog.
Right, geography acts as a massive gatekeeper here. The native Shop Pay Installments option, despite being deeply integrated into Shopify, is incredibly restricted. It is only available if your primary business is located in the United States, Puerto Rico, Canada, or the UK.
Okay, so a pretty limited list.
And furthermore, your store's payout currency has to match the local currency exactly.
Meaning, if you are a merchant based in France, or your entire growth strategy relies on reaching European buyers, the native route does absolutely nothing for you.
Nothing at all. That is where the third-party providers like Klarna become indispensable. Klarna can be activated as a local payment method inside Shopify payments for merchants in 26 different countries. It allows you to display localized financing options to shoppers across much of Europe.
And the international adoption rates cited in the guide are just staggering. They pull data from a 2025 Global Payments Report, which estimates that in 2024, buy now, pay later accounted for a massive 20% of all e-commerce transaction value in Germany.
Yeah, 20% is huge.
20%. In Australia, it hit 15%. By comparison, the U.S. was sitting around 6%.
Those numbers really illustrate why evaluating your geographic customer base is the most important technical decision you will make. Different cultures have different aversions to traditional credit cards. In Germany, for example, there is a historical preference for invoice-based purchasing.
Oh, like receiving the goods before parting with the cash.
Exactly. BNPL digitizes that cultural preference perfectly. If you ignore this international data, you might spend a month integrating a US-centric tool only to realize that half your customer base physically cannot use it because their billing address prevents the widget from even loading.
Right. But geography isn't the only roadblock here. The source details strict category restrictions. There are hard stops on what you are allowed to sell. Like, you cannot use these services to fund recurring subscriptions. You can't use them for low-value cards under $35. And crucially, you generally cannot use them for digital or downloadable goods.
Yeah, the digital goods restriction comes back to fraud prevention. By Now, Pay Later relies heavily on physical shipping data as a layer of security. If a bad actor uses a stolen identity to buy a $500 software package, downloads it instantly, and defaults on the loan, the lender is completely out of luck.
Because there's nothing to track.
Right. There is no physical address to track, no physical delivery to intercept.
And beyond digital goods, there's a long list of prohibited items. Regulated products like tobacco, weapons, gambling, financial services. If your store's catalog even brushes up against these categories, Shop Pay Installments and Affirm will reject your application immediately.
Klarna and Afterpay have their own equally strict acceptable use policies too. The guide emphasizes that this is a silent killer of store launches. Merchants will spend tens of thousands of dollars building a beautiful website, securing inventory, running marketing campaigns.
Only to get blocked at the finish line.
Exactly, only to have their payment gateway shut down on launch day because their core product violates the lender's terms of service. You have to verify your catalog against the lender's acceptable use policy before you write a single line of code.
Here's where it gets really interesting. If we know that these providers have different regional strengths, right, like Klarna dominating Europe, Affirm covering the US, Afterpay having deep roots in Australia, why wouldn't a merchant just install all of them?
Oh, I see where you're going.
Like, why not run the native integration and then stack all 3 third-party apps on the checkout page so you blanket the entire globe and never miss a single potential customer?
I mean, it is a logical thought for someone trying to maximize conversion, but the guide strongly advises against it for several reasons. First, you run into the platform's technical limits. Shopify's payment customization architecture caps the number of payment methods you can actively modify or display at checkout. But more critically, these lenders actively despise sharing the spotlight.
Oh, they want exclusivity.
Very much so. They don't want the customer stopping to comparison shop interest rates between Affirm and Klarna right when they are supposed to be clicking the buy button.
That makes a lot of sense.
Furthermore, trying to stack them creates a miserable user experience. These tools operate on different rails. Some are native integrations, some act as local payment methods, and some rely on standalone app iframes injecting code into your page.
Sounds messy.
It is. When you stack them, they frequently conflict. Widgets overlap, page load times plummet, and you overwhelm the buyer with cognitive overload. A confused mind says no. You have to strategically choose one primary partner that aligns with your largest customer base, rather than trying to duct tape a global patchwork together.
So, because this industry is capturing such massive chunks of the global economy again, 20% of all e-commerce in Germany is just an astronomical figure. Governments and regulatory bodies are finally stepping in. The landscape is shifting in real time.
We are definitely witnessing the end of the unregulated era for this technology. The guide highlights major regulatory milestones. For instance, as of July 15, 2026, the UK's Financial Conduct Authority, the FCA, officially brought Buy Now, Pay Later under formal regulation. They categorized it as deferred payment credit.
Which means what exactly for the lenders?
It means they are no longer operating in a gray area. To offer these services in the UK, lenders now require formal authorization or temporary permission from the FCA. They have to adhere to strict consumer protection standards regarding affordability checks and, how they pursue debt.
And in the U.S., the regulatory environment is a bit more volatile, right?
Mm-hmm.
The Consumer Financial Protection Bureau, the CFPB, had issued a major interpretive rule in 2024, attempting to classify these lenders as traditional credit card providers. But they actually withdrew that rule in May 2025.
Yeah, the withdrawal of that specific rule doesn't mean the CFPB is ignoring the market, though. They are just recalibrating how they define the technology. If we connect this to the bigger picture, the data these agencies are collecting tells a very compelling story about the health of the industry. The U.S. market is not spiraling into a catastrophic debt crisis. It is maturing.
The scale of the data in the guide is incredible. The CFPB sampled just 6 large lenders, which, they note, only represents about 40% of the point-of-sale financing market. But in a single year, those 6 lenders originated over 335 million loans.
That's a massive volume.
Yeah, that equates to $45.2 billion in consumer spending. But the average loan size was only $135.
That average loan size is key. It proves this isn't just people financing luxury vacations or Rolex watches. It has become a utility for everyday purchases, apparel, basic home goods, minor repairs. And the most revealing metric from the regulatory data is that late fees and charge-offs actually fell compared to previous years.
Let's clarify charge-offs for a second. That is when a lender essentially gives up trying to collect a bad debt and writes it down as a total loss on their books, correct?
Exactly. A falling charge-off rate means two things. First, the lender's underwriting algorithms are getting significantly more accurate. They're much better at predicting who can actually afford to pay them back.
And second,
Second, consumers are becoming financially literate regarding how these installments work. The novelty has worn off, and they are managing the debt more responsibly. The industry is transitioning from a Wild West tech disruption into a stable, heavily regulated financial utility.
so what does this all mean? Like, if you are the listener, a store owner trying to navigate this today, how does a CFPB report or an SCA regulation affect your daily operations? It really comes down to liability. You have to pay extremely close attention to how you market these tools on your website.
Right. You are no longer just marketing a cool pair of sneakers. The moment you place a buy now, pay later widget on your product page, you are technically advertising a financial credit instrument.
You are advertising a loan.
Yes, and the guide strongly warns that you must treat any regulatory notes provided by these apps as background context, not legal advice. You have to ensure that the messaging on your site, the fonts, the disclosures, the promises of 0% interest complies not just with the lender's terms of service, but with local truth in lending laws.
Wow.
Yeah, it is a layer of legal responsibility that simply did not exist for the average e-commerce merchant 5 years ago.
We have covered a tremendous amount of ground today. We started by mapping the fundamental choice between the seamless native Shop Pay integration and the broader, more localized reach of the third-party apps. We followed the money to reveal that the merchant fee completely replaces your standard credit card rate rather than stacking on top of it.
Yep.
We unpacked the harsh reality of the refund trap, where the lender keeps the processing fee because they already performed the risk assessment.
We also navigated the geographic limitations, the strict category rules that prevent you from selling digital goods or subscriptions, and we examined how global regulators are forcing this maturing market to adopt formal consumer protections.
It is a dense, complex ecosystem. But before we wrap up, there is one subtle, almost hidden detail in this 22-minute guide that we haven't tackled yet. And honestly, it might be the most critical question a store owner can ask themselves.
Oh, absolutely. It raises a profound question about the core value proposition of these services, which we can call the conversion illusion.
The conversion illusion. I like that.
Right. Because the source explicitly points out that while vendors love to splash case studies across their websites claiming massive increases in average order value and conversion rates, no provider publishes a verified conversion lift with a transparent, disclosed methodology.
That is a stunning detail.
Yeah.
So all of those massive headlines like increase your sales by 30% simply by adding our checkout button are largely unverified marketing claims.
They are unverified by open, peer-reviewed data. The lenders aren't releasing the raw data of how they conduct their A/B testing, which leads to a final thought for you to mull over as you build your store.
Let's hear it.
If nobody can actually prove with transparent data that buy now, pay later drives net new sales rather than simply shifting how your existing customers were already going to pay anyway, are you actually growing your business by offering it? Or have we reached a tipping point where merchants are simply paying a higher non-refundable fee just to keep up with baseline consumer expectations?
You have to ask yourself, are you investing in actual growth, or are you just paying a new checkout tax for the privilege of operating in the modern economy? That is the kind of question that forces you to really look at your margins. Thank you so much for joining us on this deep dive. Keep questioning the consensus, stay curious, and keep exploring the real mechanics behind your business.